Hi, my name is Ajat and welcome to Rock with Options, a show for all your option needs. This is the show where we talk about option strategies, mechanisms, adjustments, risk and reward. We also go one step forward by combining concepts with real-time trades to ensure the learning is complete and holistic. Today we are talking about a very simple option strategy that can be employed at a portfolio level. The idea is to kind of generate a monthly income from the portfolio that we hold. If you look at the portfolio, there are always stocks that are never in sync with the market gains. Say for instance, ITC. The stock is really good, earnings are great, but the stock just doesn't move. The dividend yield is pretty good as well, close to 5%. So the question is, how do we derive more value out of these stocks? The other stocks that we like is Infosys, the blue chip stocks, right? Infosys, HDFC Bank, which are mildly bullish, which just doesn't run away significantly. But the question is, can we derive more value from these stocks, which will always be in our portfolio? The answer is covered call strategy. Let's look into the details. Covered call strategy. Let us look at it from a very high level and see what are the requirements, the mechanisms, and the outcome. One requirement is that you already own the stock. You already own the underlying. Either you could have bought the stock as a part of your portfolio, or you might have gotten assigned because of the cash secured put strategy. If you want to learn more about the cash secured put strategy, click on the link above. The mechanism is very simple. You're going to just sell a call option. We are just going to get into details of where, when, how to sell that option. But it's the simplest of the strategies. We will just sell a call option. What is the outcome? The idea here is to pocket the premium that has been collected by selling that call option. Right? The stock doesn't rally. You continue month over month. You continue to pocket that premium, and that kind of generates a monthly income. The worst outcome, if there is any, is if the stock rallies significantly, we don't mind selling the stock because now the stock has run off significantly, and we don't mind selling the stock at the price that we like. So if you look at both the outcomes, it is both works in our favor. So it is a win-win strategy. Now let's get into the details. Now let's look at the setup, the scenarios, and the outcome of the strategy. Here I'm going to take a hypothetical example, but soon we're going to talk about a real-time trade to get a better understanding. Let's assume I bought some stocks at 100 rupees, 1000 quantity, because that is the lot size, that to match the lot size. I don't mind selling the stock at 120 rupees because I feel 120 rupees is a reasonable price, 20% more than current price. So if I were to sell at 120 rupees, the expected gains is 20,000 rupees. Now what I do is I go and sell a call option at the strike price 120. Again, remember 120 is the price. I don't mind selling the stock. The premium collected is about 2 rupees. Lot size is 1000. So total premium collected is 2000 rupees. So for the call option to yield profits for me, the stock price has to trade below the break-even point of 122. How did we come to 122 rupees? The strike price is 120, premium collected is 2 rupees, so break-even point is 122. Now let us look at various scenarios. Case 1, the stock consolidates, it stays below that break-even point of 122 rupees. I pocket the premium that I've collected from the call option. Right? Very simple. Let us look at the scenario 2. What if the stock falls? Right? I already own the stock. If the stock falls, I pocket the premium again because now the stock is trading well below the break-even point of 122. I pocket the entire premium of 2000 rupees. However, since the stock has dropped down to 80 rupees, I'll see an M2M loss of minus 20,000 rupees. Remember, I already own the stock, so any which ways I would have seen a negative tweak of 20,000 rupees. But here Because of the call option, I gain 2000 rupees, so net loss is only minus 18,000 rupees. Scenario 3. What if the stock price rallies to say 130 rupees? In this case, I'm going to close the option and sell the stock. Remember, we didn't mind selling the stock at 120 rupees. So closing the call options, since it's in the money, the difference in strike price is 130 minus 120 is 10 rupees, minus the premium collected 2 rupees. So the net loss on the option is 8,000 rupees. Now I get to sell the stock at the spot price of 130 rupees. So I gain about 30,000 rupees. So net profit booked is 22,000 rupees, which is in fact higher than the profit I would have made if I sold the stock at 120 rupees. So if you look at all the three scenarios, right, it works in my favor. In case of scenario 1 and scenario 2, if the stock continues to stay below that break-even point of 122, I can continue to sell a call option and continue to generate a monthly income as long as the stock does not breach the break-even point. So that is how we will be able to generate a monthly income on a stock that is part of our portfolio or sitting in my Demat account. Now let's look at the payoff charge, which just gives us the actual impact of this particular strategy. If you own the stock, the outcome is linear. If the stock gains, you're in the positive. If the stock loses, you're in the negative. What is the payoff if you sell a call option? As long as the stock price does not breach or go beyond the break-even point. In the example discussed, it was 122 rupees. If it does, as long as it does not go beyond that break-even point, you make money. You pocket the premium that you collected by selling the call option. What happens when you combine both? This is the outcome. As you have seen, right, as long as the stock does not breach that 122 break-even point, both the stock gains as well as you pocket the premium from the covered call. So in fact, even when the stock does not move and stays at 100 rupees, right, even when it stays at 100 rupees, you collect the premium from the call option, which is 2000 rupees. That is why even when the stock does not move, you continue to pocket the premium of the call price, and it is positive for you. If the stock goes beyond 122, if it goes beyond 122, your your call options will start yielding negative results. Your stock gives you positive results, which will offset each other. So your max profit is 22,000 rupees. Remember, I was always willing to sell the stock at 120 rupees, whereby my profit would have been just 20,000 rupees. And if the stock didn't move anything, or if the stock tanked, I would have anyway continued to see M2M losses on that particular stock. Here, by employing this strategy, I continue to collect the premium month over month. Now let me introduce you to a very innovative concept called cost basis reduction. So remember, I bought the stock for 100 rupees. First month I sold a call option at 120, collect a premium of 2 rupees. Stock did not breach that 122 break even point, and let's just assume the stock remained at 100 rupees, right? So I collected a premium of 2 rupees. I bought the stock at 100 rupees. So net effect, because I've already pocketed 2 rupees profit, the net effect is the cost of the stock is now reduced from 100 rupees to 98 rupees. Let's assume the following month again I sell a call option at 120 rupees. This time I collect a premium of 1 rupee. If the stock does not breach the break-even point, I collect that 1 rupee. So again, net effect, this reduces the cost basis by another rupee to 97. If I continue to collect the premium from the call option month over month, I continue to reduce the cost basis of the stock. And over a period of time, the cost basis can become zero. This is basically because I collected over a period of time, I've collected 100 rupees from pocketing the call option, and 100 rupees is the cost of the stock. So in effect, now the cost of the stock is zero. So the cost, so I've acquired this particular stock for free. The current price of the stock is actually becomes the profit for me. So it's a very interesting concept, and you can keep employing this strategy month or month, collect the premium, and keep reducing your cost basis on the stock price. Now let's take a real example and apply the same concepts of covered call strategy. ITC is one of our favorite stocks on which I play covered call strategy, and the reasons are as follows. One, liquidity. Since we are selling out of the money call options, it is critical that there's enough liquidity in the option that we are interested in. If there's not enough liquidity, then the option prices could be inaccurate. With ITC, we don't have that problem because 60-90 days out, the liquidity is pretty healthy. Implied volatility. We always look for times when the implied volatility is high so that we can collect more premium, thereby reducing our cost basis by a bigger margin. We want to, for employing the covered call strategy, we always look for stocks which are mildly bullish. We don't want stocks that keeps falling in our portfolio. Neither do we want stocks that kind of run away, whereby we have to keep selling the stocks and buying it again. So we want a stock that is mildly bullish, and ITC is one of them. Strong earnings, stock doesn't move significantly. We also know that there is a very strong support for ITC at 200. Very rarely it has dropped below 200. So even if there's a negative trend in the marketplace, we know ITC is not going to dip below 200 rupees. Also, the dividend yield is pretty healthy at 4 to 5%. Now let's look at the mechanics. Currently, the ITC stock is trading at 218 rupees. So I will go and buy the stock at 218 rupees. I will buy about 3,200 quantity because that will match the lot size on the call option. I don't mind selling ITC at 225 rupees. I believe that it's a healthy move for ITC within a one month period. So if it does move to 225 within a month, I don't mind selling ITC. So I sell a call option at 225. And the premium for the call option is 3 rupees. So I collect 3 rupees premium on the call option. So the lot size is 3,200. So the total premium collected is 12,800 rupees. The break-even point, which is the strike price, which is 225 plus the premium collected 3 rupees, is 228. As long as ITC trades below 228, I continue to pocket the premium that I've collected from the call by selling the call option. Now let's look at the payoff. So now let's look at the payoff for various scenarios. Let's assume the stock is in the range of 218 rupees and that break-even point of 228 rupees. We pocket the premium of the call option. If the stock does not move above the strike price of 225, we pocket the entire 3 rupees. If the stock is trading between 225 and 228, the premium pocketed is anywhere between 0 to 3 rupees. Let's assume that the stock is below 225. So the premium that is collected is 12,800 rupees per month. That's a return on investment of 1.9%, considering the overall portfolio of both the stock as well as the call option, the money for the fund that is required for funding the stock as well as the call option. Remember, I have not considered the M2M gains that you will see on the stock because now it is trading above the purchase price of 218 rupees. Just on the call option, a return on investment is 1.9% of the overall portfolio. Scenario 2, what if the stock falls, right? So again, we continue to pocket the premium, which is about 12,800 rupees. The ROI is 1.9%. Obviously, you'll see net loss, M2M losses on the stock. Again, remember, assumption is that we don't mind holding ITC for the fundamental reasons of the stock ITC. Now here we are trying to get additional value out of the stock. Let us look at the last scenario. What if the stock runs away to, say, rises above 225, say it goes up to 230 rupees. Here we close the call option and we sell the stock. Since the call option is in the money, the loss on the call option is the difference in the strike prices, that is 230 rupees minus 225, and plus the premium collected, which is 3 rupees. So the total loss on the call option is 6,400 rupees. Now we can also sell the stock at the spot price at 230 rupees. Buy price is 280. So gain on the stock is 38,500. The total gains is 32,000 rupees, which is again healthy. Again, remember the assumption that I didn't mind selling the stock at 225 rupees. Now I'm getting better value by employing this particular strategy. If the stock remains below that break-even point of 228, I can continue to sell the call options. So this month I might have sold at 225. Next month I might decide that stock has rallied. It can see further upside. I might decide to sell a call option at 230. So I can continue to do this month over month to generate a very healthy income, monthly income. As you can see, even the ROI is pretty healthy on the overall investment, not even considering the gains or the losses on the stock price. As you have seen with the strategy, the outcome under all the scenarios is in our favor. The only risk, if I have to talk about, is when the stock falls considerably, thereby the premiums that are collected at the desired strike price is low. In the previous example, ITC, if the stock drops down to 200 rupees, the premium collected at 225 will not be 3 rupees, will be somewhere in the range of 30-40 paisa. So the monthly income generated will drop significantly. In such cases, you need to recalibrate and see what is your desired price. If that can be reduced from 225 to 220 to collect a healthy premium. Here are the list of stocks that the strategy can be employed more cost effectively. Remember, we need to have enough stocks that matches the lot size for that particular stock. The stocks with the lowest amount of fund that is required to play the strategy is Divi's Lab, Asian Paints, and Infosys. In summary, covered call strategy is a great way to generate a monthly income on the portfolio that you own. You continue to pocket the premium that you obtain by selling the call option if the stock does not rally. This in effect reduces the cost basis of the stock. If the stock does rally, and you get to sell the stock at the desired price. Clearly, this is a win-win strategy on all fronts. I hope you liked what you watched. If yes, please do subscribe to us. If you have any queries, do post. We would be very happy to address it. Thank you very much.